Hello again. This is Josh Kahr at The Real Angle, and today I'm speaking with Maxwell Wu, CEO of Fulcrum Properties. Max, how are you doing today?
Doing well, Josh. Thanks for having me on.
Thank you for joining me. Always good to see new and returning faces. In the interest of full disclosure, we met when you were at Columbia going through their real estate development program. What would that be like? 2013? Was it
Yeah,
20?
yeah. It's been some time, and it feels like time hasn't passed. So that's a good sign. But yeah, formative years, and set us on a track for a very interesting last decade or so.
100%,
Um,
100%. I've taught at Columbia for almost 20 years now, and it is always amusing to me to see where people end up. Because, your memory, when you're an instructor, your memory of them is frozen in time. And then, 10, 20 years later, they're CEOs and managing directors and, like, real people with real jobs and stuff. It takes me a moment sometimes to be like, oh, right, it's been, X amount of years. So it's all good. It's all good. It's all good. So
well, we'll have
so
some
yes,
interesting stuff to talk about. Less case studies, more real stuff.
sounds fantastic. Sounds good. Yeah, no, it's the real world, so to speak. So so let's talk about Fulcrum to start with. So what is Fulcrum?
Yeah, so Fulcrum Lending, we're a exclusively multifamily lender, lend nationwide. Multifamily defined as 5 units and up. Really important to differentiate between the 1 to 4 space, which is really resi,
Sure.
versus our space, 5 units and up. Really what differentiates us from a lot of other lenders in the market is that we're really high leverage lenders. We can lend down to a 1.0 DSCR, debt service coverage. So that kind of shakes out, given today's cap rates, and we can get into cap rates, but given where valuations are today, that kind of shakes out to about a 70%, maybe almost 75% LTV on these properties. As you can tell, 75, 70 doesn't seem like that much, right, relative to yesteryear or pre-rate hike,
Sure.
but today it feels like a lot, especially for a lot of other lenders. But given what our secret sauce is, which is frankly a lot of data, helps us get really smart on the markets real quick, and get us comfortable in lending those high leverage levels. Price per pound, right? We like to think that it's a better price per pound, but we just offer more money, right?
Now
I think
now
another.
now now I'm
Mhm.
curious when you talk about your lending. So are you whose money are you lending? Are you a balance sheet lender? Are you doing Fannie Freddie? Like
Yeah,
what is Fulcrum's role in this process, I guess?
yeah. So we actually started off as a correspondent for Freddie and Fannie. That was a previous platform that was built, and frankly, they have a really fantastic program and product and just process. Anyone who's
Mhm.
been to the agency lending process understands that it is quite cumbersome at times, but they really do offer some of the best terms and the best leverage in the market, price per pound, like I was saying. But given the recent rate increases since 22, there were a lot of deals that just got hung up, got kicked out of the process, got proceeds cut, right? And we're seeing
Right.
this kind of shape unfold. And I don't need to tell you this, but gap financing is certainly come in vogue, and it's always been useful. But nowadays it's really a need. And we were able to pick some deals up out of agency processes, help these borrowers out who have money hard, and where the lender came back and said, hey, we have to cut leverage 10 points, right? That's a lot of
Right.
money to raise in 30 days or so. So that was kind of the genesis of us moving over from the agency side over to the balance sheet side.
Got it.
I would say we would have moved into the balance sheet side later on, but the acceleration of just the world around us kind of presented the opportunity, and we jumped at it. We've been able to get some really nice paper out there at some. I think we looked around the corner in terms of where rates are going, but I think they're still very safe levels right now.
Right.
But yeah, I mean, that's kind of the genesis of us into where we are right now.
So it's not really that we wouldn't describe you as a bridge lender, right? You're still giving long-term loans. It's just you're trying to give higher LTV, basically, than Fannie and Freddie and what have you.
It's one of those weird things, right? Where it's, yeah, we are not your classic bridge lender.
Okay,
12% money, 2 year plus one, right?
sure.
This is really, I mean, quasi mini perm, if you want to call it that, right? Where it's, a hybrid between bridge and, 5 year conventional debt, right? Your
So,
five
like,
year convention.
what kind of length term? What kind of term length are we talking?
I mean, we prefer 10 years, right? But
Okay,
at these
okay,
at these levels, right? We've been doing a lot of 5 years, right? So
sure.
that's really dictated by the borrowers, right? The borrowers are gonna, we're not going to be able to finance anything if the borrower doesn't say yes to it, right? So,
Right, right, right.
creating a product that's flexible for the borrower and what their need is today. Another interesting thing is, in addition to our 5 year product, right, which gives just more room to run, more time to breathe for the sponsor, right? Sort things out, right? We believe, the real estate's great, the market's fine. It's truly we're in a credit crunch,
Right.
and we just need to be able to provide liquidity to good sponsors. Um, but another, aspect of our loan is, these flexible prepays we can offer, which are, declining prepay in addition to minimum interest, which are certainly less onerous than defeasance or yield maintenance. Um, Other aspects, right, were, as mentioned, the 1.0 DSCR. So your debt coverage ratio, typically folks lending at 1.0, they're going to use an amortizing debt service, right, to size it. We do it based on IO. That
Oh,
being
so
said,
it's
we're
actually true IO. It's interest only money. Yeah, which means you can put out more proceeds, and then you're making a
yeah,
bet essentially that the value will obviously go up if you're not worried about amortization.
that's right. That's right.
Yeah, yeah.
From our perspective, 1/30th amortization, right? It's not moving the needle when we're lending at the levels we're lending at.
Right.
Um, and like I said, a little bit of the secret sauce is the proprietary insights we're able to gain, from the data that we have and get comfortable at these leverage points. Um,
Let's talk
but
about
yeah,
technology for a moment, because I mean everything you're saying makes sense, and I mean the way the market responds whenever money's not available, there are people who will eventually step into the market and provide that product, and it makes sense that your product exists now based on where we are in the market. But the technology aspect is fun. So when you talk about certain insights you get, like what I know in your background, you've done some stuff in prop tech. So can we talk about that for a bit? I want to understand technology wise what you're
yeah, yeah,
driving at.
definitely. In today's world, technology drives a lot. That being said, right, we're investing real dollars on behalf of, this is institutional money, right? It's on behalf of,
Right.
insurance, pension, like, people working really hard, save up money for retirement, right? This is a little controversial to say coming from a guy who comes from tech, but to fully replace the human element, right? I think we're still a little far off from it.
Sure.
These are large dollars at stake for, like I said, very real people, that depend on these dollars, and to have it fully automated, far off. But what we've created is basically a system that takes the deal from 0 to 90 really quickly.
Okay.
We can size up a deal in 30 seconds. And then where we spend that last 10% of the time is really, massaging the deal, really turning each kind of nook and cranny, like checking out every nook and cranny, turning every screw that you can to fine tune it. That's really where you find the best deals. That's how you can structure the best deals. But it just comes down to time. You just need to give yourself the amount of time to spend on it. Technology helps us do that. It helps us do these rote processes very quickly so that we can do these, let's call it higher value, tasks, or activities, required to make a good deal happen. Um, so it's not, like I said, it's not to say that eventually we won't be able to automate more. Maybe we automate up to 95%, but I always like to emphasize that there are, real eyes, on these things, and, conversations
No,
being had about the credit. But I mean, it's not to discount the technology at all, right? I also like to caveat that. So, it's incredibly important to be able to move as fast as we do, because for our business, right, and I can kind of get
mhm.
into why that I like this business in particular. Multifamily seems really vanilla and bland and all that, but at these leverage levels, and at scale, it makes it very interesting. But to do it at scale, you got to have automation. You have to be able to do multiple things at once. So technology certainly
Well,
helps there.
well, yeah, the tech side is interesting. I mean, look, I mean, we've been following. I mean, or actively or passively, I think all of America has been following Elon Musk and the self-driving car. And we've been hearing for a number of years that Elon keeps saying, "Don't worry, we're going to have it, any very soon." And I mean, I'm not faulting him. I'm not saying he's lying. I think it's just more that's really hard to do. Getting 90% of the way there is one thing. Getting to the point where you can fall asleep and let it just drive yourself is a whole other conversation. So that's what I'm hearing is using the technology to get 90% of the way down the road, so to speak, and then, use human brains for the stuff that the machine can't understand. Which, it's funny. That's a much more adult or intelligent way of looking at technology, as opposed to people freaking out about how AI is taking all of our jobs. It's like, no, it's making me work better. That doesn't mean I don't have to work. So, yeah, that makes
Exactly.
sense to me.
It's about leveling up where anyone is at that one point, right?
Sure.
And I
Yeah.
think that's really the way people should be looking at it, and
No,
not like, it's
it's
taking
a
their
tool.
jobs.
It's a tool. I as a side hustle, not hustle, as a side hobby, I do some woodworking sometimes just because I enjoy it. And there's a difference. It's power tools versus hand tools. It's still a saw, but
Hmm.
you still have to be someone's still got to be using the device. So unfortunately, it does not build the birdhouse itself. So it needs a still need a human being involved. Still need a human
Yeah.
being. So okay, so you built this technology platform, you're sizing up these deals. Um Nationwide, certain markets. I mean, I know every lender says they can lend everywhere, but in practice, what markets have been most fruitful for you, if you will?
Yeah, yeah. I mean, certainly, I'm not going to tell you anything you don't know already, but certainly the Southeast, right? The Carolinas, that little
Very
region
active
right there,
market.
very
Very.
active market. Still think there's fantastic strength there. A lot of supply came on recently, but I think when you look forward, right, um, permits are down, right? Needless to say, interest rates have driven a lot of developers to the sidelines. There's not going to be a lot of new inventory being built up for the near future.
Right.
We like that dynamic. It gives some of this pipeline of construction time to kind of grow into itself.
Hmm.
And there may be a little choppy, say going into the end of the year and to the beginning of next year. But I think there will be some natural absorption and right sizing of the market. So got to be selective there. I think the Southwest, again, not surprising for you, I'm sure. A lot of activity there, a lot of gap financing needed, a lot of sponsors that took out debt at pretty frothy levels,
Right.
that are going to have to put some money back into the property. But again, looking at the fundamentals of the market, net migration, AMI growth, and even in some markets where let's call them small markets as defined by Freddie and Fannie, and these are kind of live off of core MSAs, right? We like those
Hmm.
markets that live off the core MSAs. We think there's, good dynamics there, call it work from home, but
Got it.
also just, again, net migration, population has to flow outward from that city center. Um, and, the work from home kind of helps support some of that thesis.
Yeah,
But
the
we're looking
work
at a
from
lot of top down data to look at these top 50 MSAs we're looking at.
yeah, the work from home data is interesting. I mean, I I certainly would not want to own an office building in the central business district right now. I mean, I still do some consulting work on the side, and I'm working with a client of mine up in Boston, like rejiggering a lot of their financials because they have a lead weight. They've got a large office building in downtown Boston. They got a lot of expirations coming up, and they're playing the game of, well, what if it goes to market? In today's market, now what? And
Hmm.
they're smart guys, and they've got a smart institutional partner and all this sort of stuff. But there's no good answer. It's like you've destroyed huge amounts of value. There's no magic. Yeah, it's going to be very curious to see what happens to a lot of those markets. It's
Yeah,
also
yeah,
interesting when I think about sort of markets like where I'm based, northern New Jersey. I mean, northern New Jersey's whole reason for existence is that it's next to New York City, So then you start to say, well, if New York City goes through economic trouble, that's great that our values spiked briefly when people moved out during COVID. But long term, if New York starts to go in the wrong direction, then why do I have this nice house in northern New Jersey? I could, sell it and buy a mansion anywhere else in America. The Which is true. I mean, my house is relatively modest, but if I sold it and bought, somewhere in the Carolinas, for example, I could live much, much better.
yeah, yeah. Quality of life. Yeah, I mean, just I was just down in Cary, North Carolina, and that's a fantastic market. Really
Sure,
positive, just demographics and tailwinds. Education, healthcare.
all those things.
Very safe community as well.
Right.
Really love that, and you see the income growth there is monstrous. So it's
I was in Asheville last week. I was there Tuesday looking at a deal, and
excellent. Yeah.
yeah. And by the way, it's always funny when you do site tours. I'll just share this with you. It's off topic, but it's still amusing. So doing the site tour, walking around, doing all the normal things you do on a site tour, and I notice on the second floor of one of the buildings, you can see the grow lights through the window that the guy's got running, and it just felt very Asheville, North Carolina, that the guy had grow lights on the second floor. And I said to the broker, "So he's growing tomatoes?" And the guy laughed, and we just kept moving, because it's Asheville. Like, like what do you? Not to besmirch an entire city, but I wasn't that shocked. I wasn't that shocked. So
Yeah, yeah. Look, these, these agricultural driven economies I really like. I
sure,
think those are fantastic economies.
yeah,
A lot of just strong fundamental growth there.
right, right,
Um,
right, right,
and I really do think those are going to have like a kind of a second coming, as this millennial group continues to realize they don't want to stay in really tiny apartments in the city and realize
right.
that yeah, they're going to have more than one kid, they're going to have two, probably three kids.
If they do,
um,
totally, totally, or if nothing else, just they don't want to be in a small apartment in a in a CBD.
yeah.
Yeah, no, the Zoom technology thing. We're looking at the entire reordering of American society. I mean, that's the reality of it. Um, and so, yeah, no, that's obviously going to affect where lending is. So, team wise, so you're based in where's the home base? You're based in New York City, is that correct?
Yeah, based in New York
Or
City. Yep.
New York?
Midtown East. Yep.
So, a lot of these big national lenders, they have locations all over the place. So now that we're entering this Zoom world and you're doing all this stuff with tech, even if you grow and become mammoth, do you need a Dallas office? Do you need an LA office? Or does it just not matter anymore?
That's a great question and something that we kick around, frankly. I still think, again, this may just be, I mean, we're real estate guys, right? I think, and
I
especially
know.
the time that
That's why I'm
that
asking. That's why I'm asking.
that we came up in this business, it's hugely relationship driven, and meeting people face to face makes a huge difference. I mean, I will say, look, I'm way more productive going from Zoom meeting to Zoom meeting to Zoom meeting.
Hmm.
Like when we're doing road shows, right? I'll give you an example. I was in San Francisco. I had to go. I was down in downtown San Francisco. I went down to San Jose. I went over to Walnut Creek. Four meetings in a day. Took the entire day. I can't. I mean, we were just in the car, just,
Sure.
I think I took a nap maybe in one of the legs, right? And you're just entirely
You get
exhausted,
tired.
right?
It's tiring.
And so
Yeah, totally, totally.
there's a case for productivity, absolutely. But again, going back to investing dollars on behalf of real people, right, that rely on you to uh, invest in these durable assets, dependable things, right? You got to go meet the managers in person. You got to go meet the sponsors in person. We're never going to look at a deal and not finance it, or we're never going to look at the deal or fund the deal and not visit the property. That's just it. So,
Sure.
being able to be there and kind of see where people are moving, where things are flowing, right? There's still no real augment to that. Um, it's going to be a hybrid thing. It's going to be a hybrid thing. Um, Maybe
For a
in,
while.
10,
For
20,
a
20
while.
years. For a while, yeah, for it,
Yeah.
you know, as there's this kind of generational shift, even from the large asset managers, I think, large family owned ones are a good example, right?
Hmm.
And
Hmm.
let's say the second or the first in line is maybe 40 years old or something, and now is about their time to take over. They've grown up in a completely different environment, understand ways to optimize, again, use technology to do more rote processes a little bit faster, right? And that's going to help. But I think once people realize that, well, I don't think it's once people realize. I think once people remember how important the person to person side of it is, it's going to continue to be hybrid. And the
No,
big ticket deals and important relationships, you're always going to make time.
you still have to meet people. You still have to meet people. I mean, I realize, I'm 50, so I realize my perspective is different than other people because we're all different ages. Um, yeah, on one hand, I love technology, and I think it's great that we're using these technologies. I am with you though on that. There's a lot to be said for just simply sitting down in a room and talking out a deal, just understanding what the relationship is. So yeah, no, we've not made that shift yet. It's it's a huge transition. It's a huge transition. So as far as the market evolving, I mean, you're doing gap financing essentially, which is definitely something that's, I don't want to say all the rage, but definitely something that's a much bigger thing now, whereas it wasn't certainly 36 months ago. Um, how long do you think the window for gap financing exists before we start to get back to more traditional? I'll just go to Fannie and you're a correspondent lender and you'll lend me some money. You'll lend me Fannie's money. How much longer do you think that window of opportunity exists?
It's kind of the magic question, right? I look. We track a lot of different data sources. One thing we follow closely is money supply, this M2 number. That's dollars out in circulation.
Sure.
That's a very real number and probably the most tangible way you can think about money.
Hmm.
And an example I often give is that one out of every $3 in your pocket just showed up, right, magically. And that's because about a third of the money in circulation was printed over the last, call it 3 years. That's an insane
Hmm.
amount of money. So
It is.
practically speaking, right? Again, just think about $1, and you can think about kind of how much you would cherish that $1. And it depends, who you are in this whole kind of economic value chain. Some people will spend it on durables. Some people will spend it on discretionary items,
Sure. Sure.
or non-discretionary. But point being is there's a dollar multiplier effect to that, and that helicopter money went in, and the consumer spending really ticked up there. You can see corporate profits right now. If you look at earnings on the S&P, right? These are incredibly robust,
My,
right?
my favorite
And
my favorite indicator during COVID was looking at when all the helicopter money hit, looking at luxury car sales. You saw luxury.
mhm,
All of a sudden, everyone's buying a Porsche, and you're like, well, if the economy sucks, why is everyone buying luxury, exotics, if you will? And it's like, well, because
mhm,
money dropped from the sky, and a lot of people said now's the time to buy a 911, and so here we
yeah,
are.
exactly. Yeah. No, that's a great example. That's a really great example. And again, not to kind of speculate on what other people do with their money, but clearly we can see it in all the numbers coming out, right? We look at inflation, CPI, PPI,
Yep, yep.
whatever inflation gauge you want to use, numbers are up substantially.
No, inflation's
And
real, and I'll say even from my perspective, as someone who's done consulting work over the years, a client hires me for X amount of dollars, and now it's been a few years, and now we're in a different environment, and they say how much will it cost. And usually if you say to someone it used to be X, but now it's X plus 20%, clients will give you pushback because obviously why? And
hmm
no one pushes back. I just say it's X plus 20%, and everyone says okay. Like I don't even have to justify it to be like, oh, I'm more experienced and we have a relationship. They just
hmm
they just pay it.
Yep.
So it's baked in at this point. I feel if I didn't add on an inflation adjustment at this point, clients would think something was wrong. Like I must be in trouble or something. It's weird. It's weird.
Yeah. Yeah.
Yeah.
Yeah. No, it's a very odd time. But yeah, look, to not skirt around your question, right? I mean, one man's opinion based on data that we see, right? We still think that, if we continue at the rate levels that we're at right now,
Right.
I think there's another, let's call it 18 months, almost 2 years plus on this
Of
thing.
gap financing being a
Um,
product. Yeah.
absolutely,
No.
absolutely. And it's funny when I was fortunate enough to learn uh, math from my mother, who's really a mathematician. She went to crazy amounts of schooling,
Cool.
but was still able to help me even in college level and master's level stuff.
That's
But
great.
one thing that I was always taught to think about was think about this arithmetic, math, and shapes, right? And graphs are a great way to do that.
Hmm.
And when you,
Hmm.
again,
Hmm.
think about this money supply, right? You think about it like a shape. There's been this big bubble that's come up, right? And if you look at just an area of a graph, that giant amount of money that's piled up right there has to be spread out over time. So,
Yeah.
how long that takes, I don't know, right? But all I do know is that there's a ton of money that needs a lot of time to be sucked out of the economy.
Right.
And right, I'm not going to be able to guess what consumer spending is going to be or whatnot. I just know that there's a lot to do. And I don't know if, policymakers are doing the right things or doing enough to get it done. But I just also know that not enough is being done. So when
Yeah,
you
and then the
combine,
question is, how
our,
do you suck the money out without crashing the economy? Like, you want to take it
exactly,
out, but at the same time, you don't
exactly,
want to bankrupt the
exactly,
system. Yeah, because it
exactly.
does feel with interest rates being high, like I get it, they want things to slow down. At the same time, I still need to refinance properties. Like I still need to function. I mean, so it's um it's also interesting how much banks have pulled back. It's amusing to me. I may have told this anecdote on another podcast, and if I did, I apologize to my listeners. But I had a very strange experience of one of my a lender calling me up and leaving a voicemail. And usually when a lender leaves you a voicemail on a loan you already have, something's wrong because otherwise, why are they just calling? So I called my business partner to be like, "Hey, so I just got this voicemail from the lender. Can I call him back? Is there something I don't know? Did we miss a payment? Like what happened?" And he's like, "No, no, everything's fine. Like we wired the money. It's normal payment. Everything's fine." I called the guy back and he's like, "Yeah, I just wanted to see if you were interested in moving any operating accounts over to our bank." And I'm like, "No, I have operating accounts with other people. No." And then I said, "Well, out of curiosity, as long as we're just asking questions, so are you guys in the market for lending right now?" He's like, "No, no, no, we're not putting any money out." I'm like, "Okay, I now
We
know
need your
everything
money
I
though.
yeah, exactly. I need your money at 0% in checking." And I'm just thinking to myself, that tells me everything I need to know about your health as a bank. And I won't say who the lender is because I don't want to, get in trouble here. But it's there are a lot of lenders trying to put stuff together. So yeah, when
Yeah,
some of these
yeah.
guys blew up, like Signature, First Republic, what have you, I wasn't that shocked with some of these people when they got into trouble. So
I mean, you're seeing the same quotes from again, no names basis, right? I think we're
sure.
seeing similar and hearing similar bids coming out and all that. And I don't know about you, but I certainly ask myself, hey, is that paper worth anything, right? Is that actually like that? These terms just don't seem right, It's
Right.
and then you see these things close and all that, and I remember even a couple years ago, right? I'm just like, man, things just feel really frothy, and why is this happening? And we lost some good deals, right?
Sure.
But that's fine. There's plenty more out there. Multifamily, it's 400 billion annually. Typically, like just
Yeah.
normal course, right?
It's a
Normal
huge
course when
market.
when
It's a
things
huge
are when
market.
things are normal, right? So, there's plenty of deals to do. But it's just one of those things where it's like you got to take a long view. You can't think about just living till tomorrow or winning today. You want to win long term, and that requires saying no to some of these things that look really fantastic.
So last couple questions. So you're building your team. I mean, I mean, not that you're more of a start. You're not a startup. I mean, you are operational and stuff, but you're theoretically in growth mode, right? You're getting bigger and stuff. So where do you grow into? Like where does an entity like Fulcrum want to be in 3 years, 5 years? Still doing multifamily, doing other things, growing into other stuff. Where do you want to be?
Yeah, look, I mean, we're a lean team of eight, right? We're a small team,
Small
but
team.
it's one that we think is incredibly robust because of the technology that we have. We don't use third-party software, right? It's all our own software, custom built for the needs today, especially for the needs of the borrower, right? Part of, what I think success is just being able to create products that borrowers want. Those are our clients. And then, the other side is the capital side, being able to create assets or loans that are worthy of participating in, right? So, I think as long as we can continue being agile, the world's ours, right? I mean, I think right now we're starting to see that some of these really large groups have just, balance sheets upside down, things weighing them down where they can't move fast enough and adapt to where, financing needs are today. So I think that's really another, that's called secret sauce, right? Into
Hmm.
what we do is our agility to adapt to the market. And I think going forward in the next, 2 years plus, right, agility and adaptability is going to be really key, especially in volatile times. And I think really what's going to be a challenge is how do you preserve that type of speed and kind of entrepreneurial thinking as you get larger. When me and Ken started, it was even smaller, right? But you keep
Sure.
growing, you keep picking up really great people. We've been fortunate enough to pick up really fantastic people, coming out of this chaos in the markets, and we welcome that, with arms wide open. We think that's a tremendous time to build value and create value for others,
Build
and
it
get
and
paid
really
doing
build,
it,
yeah, and build your
right?
team. Build your team.
And build a team. Yeah, but I mean, in 3 5 years, we want to be, candidly, right? You asked about the office, right? Opening up more substantial footprints, on the West Coast and the Southeast, and really, build out that, platform and being able to offer our loan product for other, lenders and brokers to use themselves, right?
Right. Right. Right.
That's
And
really it.
still,
Is exactly like when you look at our technology and what it does, it's a really great way to systemize opportunities so you can look at them all apples to apples, right? And be really decisive and succinct in the credits that you want. And to be able to have that distribution, you need a lot of people, right? Again, it's a people business, and I still stand behind that. There's been some other technology businesses that tried to, cut out the broker or the mortgage banker, right? There's a lot of value that they provide, in my opinion. There are some that are not so great, but that's not to say that the entire group is not. And I think that's really important to emphasize. It's
Yeah.
always a great thing to tell investors, yeah, we're going to cut out the middleman. It's like the oldest line in the,
Right, but the middleman is actually doing things. Yeah, no,
yeah,
I
so find the
understand
right
that.
people, find the right people. But yeah, I mean, I think we have, we continue to ramp up and go nationwide, continue to stay in multifamily, maybe increase our loan products, but really expand the aperture for multifamily specific deals we can go after. I really advocate, you know, uh, especially our team, right? Focus is key. Choosing one asset class, excelling, being the best at it. That's what we want to do. We want to be multifamily only. You can expect us to be doing that, for the next, 5, 10 years, and
And build
just
from there.
keep getting, yeah, and just keep getting larger and larger.
No, look, this has been good. It's good to talk about tech. I've definitely been on the consulting side of this for some very large lenders, and a lot of people are playing catch up on just even having standardized underwriting models. It's amazing how sloppy some of the technology is internally. But then again, when the
Hmm.
market was good, I guess they didn't have to worry about any of this stuff. So, well, look,
No, no.
yeah. I mean, just unfortunately, it's amazing to me how much money gets managed with really crummy tools. Um, in any event, look, this has been very constructive. It's good to talk about the state of the market. It's good to talk about gap financing because that's definitely something that's hot right now. And yeah, thank you for your time. Much appreciated.
Yeah, I'm glad we could catch up. Thanks for having me on, Josh.
Thanks again.